Welcome to Short View Trading. My name is Chris Watling. I'm the CEO and Chief Market Strategist of Short View Trading and Long View Economics. And this is your morning market hit for Monday, 12th of August, around 10 a.m. London time. So what matters for markets if you want to trade equity index futures on a 1 to 2 week basis? You're a swing trader. You want to go either long or short the S&P futures or the NASDAQ or the DAX or the Nikkei or so on. How should you go about deciding what trade to implement? That's what we're going to dig into in this video. So the first thing you need to think about when you're going about trading equity indices is what kind of market environment are we in? What's the context of the market price action? How's it behaving? What's the price doing at any one time? Is it trending higher, trending lower, or are we in the midst of a pullback? Certainly at the moment, we seem to be in the midst of the pullback ever since the highs on the NASDAQ on July the 11th and the S&P a few days after that. We've been in a pullback phase, and most pullbacks have a typical price pattern. That is, they have a 3-wave or a 5-wave shape to them. In other words, you have your first wave of selling, the wave 1 that we saw from mid-July all the way through to the intraday lows Monday last week, the 5th of August. Then you get a wave 2 relief rally as the market bounces and takes back some of those losses, retraces some of those losses, before you then roll over into your third wave in this pullback, which is another wave of selling down to the lows of the wave 1 and sometimes even lower. That's the classic price pattern in a pullback, in a wave of risk aversion. Sometimes the 3 waves evolve into a 5-wave, and sometimes that pullback evolves into an actual cyclical bear market. Now, we don't think that's the case in this instance. We think we're in that classic pullback phase. And as I said, we've had wave 1. It was very aggressive selling. We had panic at the bottom of wave 1. You saw the VIX spike Monday last week on the 5th of August up to around 60% and a little bit higher than that. Exceptionally high level, not seen since the pandemic sell-off in March 2020, and indeed incredibly rare in equity markets to get a VIX at that level. That's indicative of forced selling, of panic, of funds that have to liquidate positions at any price. They're selling at any price, hence the VIX goes to such high levels. Now, since then, we've seen the VIX ease, that panic subside a little bit as we've rallied from those lows of Monday last week, and we've had our wave 2 relief rally get going with markets nicely trending higher. Look at the DAX, the shape of the DAX in the last week on this chart in front of you now. Wonderfully, steadily upwards. A nice classic wave 2 relief rally pattern. Same if you look at the S&P 500 or indeed the NASDAQ 100 bouncing off its 200-day moving average. So we've had the wave 1, we had the panic early last week on Monday. We're in the midst of the wave 2 relief rally. And of course, in every classic pullback, you tend to then get a third wave, which is another wave of selling. As I said, back to the intraday lows of the wave 1 or even lower. So the real question is, how do you go about judging that? How do you time the switch from a wave 2 to a wave 3, which is, of course, critical if you're a 1 to 2 week swing trader of equity index futures? So we've been long over the course of the last week, getting into a long wave 2 relief rally position in the middle of last week, running it on the NASDAQ for a while. But how do we go about judging when we want to flip from wave 2 longs to wave 3 shorts? And there are 4 key inputs into that. Firstly, we think about Fibonacci levels, how much of the losses have been retraced in the wave 2 relief rally. Secondly, we think about our short-term market timing models. These are risk appetite, primarily risk appetite type models. They measure fear and greed. Correlations go towards 1 in pullbacks. They become even more efficient, even better market timing models than normal in these sort of high volatility environments. And we take a read on them, we assess them, we look for them to go from strong buy back to sell to give us some inputs into when flip from wave 2 to wave 3. That's the second key factor. Then thirdly, in this example, we look at tech-centric models. Just look at the NASDAQ put to call ratio. Terrific sell signal at the highs in mid-July, now back at the buy levels. So interesting indicator there, got us back in the wave 2, one of the models that we use to help us. But it doesn't always get back to sell before you get to wave 3. In fact, sometimes it's pretty tepid in when it bounces. So you need to consider all that. And then finally, the fourth key factor is the price action in key liquidity indicators. Bitcoin, spreads, commodities, all of these are really interesting liquidity indicators that give you some insights into that move from wave 2 to wave 3. And all of those 4 factors are considered in today's risk appetite gauge, our daily publication that makes 1 to 2 week recommendations on equity index futures long or short, updates all our key market timing models, and talks about the context of the price action of the market each and every day. And that's published early London time, around 8 or 9 a.m. London time, way before the US Open, and is available for trialists. And of course, we send it to subscribers. So if you're interested in a free trial of that product, click on the link below. We'll send you that for a few weeks. See if it's useful for your trading. We believe it'll enhance your trading decisions on equity index futures on that 1 to 2 week time frame, either long or short. So what are we watching this week? Well, there's a few key themes. Firstly, of course, all eyes on the price action, as I've just discussed, how all asset prices behaving in this wave 2 relief rally, any signals that we're moving in to a wave 3, any sort of price action signals. But in terms of other macro data that's coming out of the course of this week, all eyes on US CPI, utterly critical. Wednesday, it surprised to the downside last month in July. You'll remember on July the 11th, it was lower than expected and triggered some quite serious rotation in the global equity market. So what will that look like on Wednesday? That's key into the way the Fed plays out, the speed of rate cuts and so on. Then secondly, over and above that, we've got a bit of inflation in the UK on Wednesday as well. We've also got a bit of PPI out the States ahead of the Wednesday CPI with the US PPI on Tuesday. Then elsewhere, we've got other bits and pieces of US macro data. We've got retail sales on Thursday. That's important. There's a lot of chat about the consumer struggling a little bit. So retail sales will be interesting in that respect. There's a bunch of housing data out of the States, starts, NFIB and permits over the course of this week. And then finally, it's a continuation of US quarterly earnings. The retailers in particular reporting this week, including Walmart and Home Depot, 2 very big retailers over in the States. So that's it from us. That's your morning market hit for Monday, 12th of August. Thank you for listening. Please do subscribe to these videos on YouTube. Simply click on the subscribe button, like and share on social media, or follow us on Facebook, Twitter, and or LinkedIn. Thank you for listening. Stay safe. Trade well.